Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert focused on strategic planning and exit planning in St. Louis, Missouri. Today, we are talking ERC tax credit information for advisors and business owners with Catherine Tindall. She's a CPA in California, specializing in tax credits, and is also a partner with Dominion Enterprise Services. She's combined proprietary technology with professional expertise with her CPA team and is able to offer a fast turnaround time on credit claims while maintaining a high degree of precision. It's her mission to help business owners in key industries affected by COVID shutdowns, such as restaurants, construction, and hospitality, to take advantage of the employee retention credit before it begins to expire in the spring of 2024. Welcome, Catherine. How are you?
I'm doing well. How are you? Thanks for having me.
Now, another thing, like this is a little bit different, but in the same space. What do you see in the future? In the future, we're going to see employee retention credit fraud increasing. But like, what does that really look like? Because I'm trying to, in some capacity, that's not really a business owner coming to their accountant and saying, hey, I got 4 employees. Let's see what we got. That's a little bit, like when I think of fraud, I think of more like I'm trying to get a credit for 50 employees and I have 3. Right. But are there other ways, are you already seeing some of this fraud come out? And is that where it's going, just sort of made up employees, or is it even more in depth than what I can envision?
Yeah, I think we've got, from what I see in the field, which is, a limited scope, and I talk to other practitioners about this a lot. It's a combination of, I'm sure there's just rampant fraud going on in the program just from me dealing with it. But more often it's negligence is really what it is. It's people who are not tax professionals trying to do this work, who are underqualified to do the work. They don't understand the nuance of the tax code, because the other thing too is it's one thing to maybe understand some parts of the program. It's another thing to understand how it interacts with the rest of the income tax code, because that's where it lives. And so, certain ways we have to interpret things or treat things come from completely other parts of the code. So it's, unless you're an actual tax professional, you'd miss out on a lot of those things. So more often it's negligence is what it really is. And people trying to do this quickly, or, just trying to do this as a profit, trying to generate these big credits and get contingent fees on them and that sort of thing, rather than the focus being on, getting the work done correctly. That's more what I see. And, this is going to be one of those situations where, my personal opinion is, like, I think a lot of people are going to end up in jail. Like, I think it's going to be a massive Department of Justice effort, because I deal with some of the claims that I see, people come back to us, I look at who the provider was and how much they've said that they've filed for, and just how off the claim that I'm dealing with is, and extrapolating those numbers. And you're dealing with, hundreds of millions of, if not billions of dollars in, overstated, negligently done claims. Like, that's the level that we're at with this program. So it's going to be it's going to be many years of unwinding from the IRS, to deal with it and to deal with the backlash from it. But that's what I see on the horizon.
And